Hello everyone. Today I selected a very important topic and a high weightage area for your examination. If you are going to write CMA final SFM, that is Strategic Financial Management paper, and ACCA paper, that is Advanced Financial Management. Also, it's useful to those students who are doing their final SEM MBA with International Finance Specialization, and definitely helpful for any PG students for getting an enhanced knowledge if their specialization is in finance. Today's topic is the use of financial derivatives to hedge against interest rate risk. So today we are focusing on interest rate hedging. That is, in the times of volatile interest rate, that is, if the interest rates are highly volatile, the companies borrowing large sums of money may wish to hedge against adverse movement in the interest rate. That could have a significant effect on the level of interest payments. That is, the company lending large sums of money may want to hedge against interest rates falling, which will have an adverse effect on interest received. There are various interest rate risk management techniques. These are some of the methods of reducing interest rate risk. That is netting, smoothing, matching, pooling, forward rate agreement, interest rate futures, interest rate options or interest rate guarantees, and interest rate swaps. Today in this video I am going to talk about the most simplest form of interest rate derivatives, that is FRA, that is forward rate agreements. First of all, I will tell you an example, then you will clearly understand what this concept means. Okay, so if suppose I want to take a loan, I want to borrow money from bank, so I approach a bank, so I want to borrow money but not today, I want to borrow after 4 months, but I want to fix the rate now. Okay, that is, this is just like forward contract. You might be studied about forward contract, right? That is, a forward contract is an agreement or contract between two parties to buy or sell an asset at a specified price on a future date. For example, A Limited enters into FRA with ICICI Bank on 1st April 2020 that it shall borrow from the bank at the rate of 12% per annum interest on 1st October 2020. So here A Limited wants to borrow on 1st October 2020, right? But the fixed rate on 1st April 2020. So as on 1st October 2020, whatever interest rate is prevailing in the market, that's no matter. A Limited will have a right as well as an obligation to borrow at 12% contracted rate only. Okay, so this is the benefit of entering into FRA. That is, you will be having a definite interest rate no matter whatever interest rate is prevailing in the market. Okay, so this is what we call as FRA. Just like a forward contract, FRA is a contract that allows an entity to borrow or invest a certain amount of money at a certain specified date in future at an interest rate agreed today. This is what we call as forward rate agreement. Okay,